Good morning and welcome to this pre-market Friday morning pre-market rundown. I'm your host, Kevin Hoffman. I'm a co-founder of TriggerCharts here. Got a lot of things to discuss this morning, but first off, the important disclosures. Investing involves substantial risk. Past performance is not a guarantee of future results, and a loss of original capital may occur. Please consider this for educational use only, and as always, use your best judgment when investing. All right, everyone. Good morning. Welcome to this webinar this morning. Markets are up a little bit on these retail sales that we saw this morning. Typically, in the past, we've seen good news being bad news and bad news being good news, and that's something that we'll discuss today. And that all revolves around the Federal Reserve. But some of the ongoing themes to consider, we need to always consider the economics. What's the big picture? We'll take a look at some of these charts of what I believe to be some of the more important indicators for the economy. Again, bad news is good news. I don't know if that's true anymore after this morning, seeing that retail sales had a big jump. And we'll talk about inflation. That seems to be an ongoing theme here, and supply chain concerns, which we had President Biden weigh in on that earlier on in the week. So who knows if Christmas is coming this year? Maybe the Grinch will steal it. Who knows? Moving on. Before we get going, I just want to make sure everybody knows, if you have some securities or equities, futures, anything else you want to look at, put them in the chat here. Let's put that here. And we'll try and take a look at those either during the middle of the presentation or toward the end. But economics this week, job openings are absolutely on fire. So if people don't have jobs, there's a lot of them available. Maybe they're holding out for higher wages, which is understandable considering the inflationary environment that we're in. But they were up to 10.4 million job openings. Previous month, we saw just over 11 million. CPI came in hot as well. CPI is the Consumer Price Index. Kind of judges the inflationary environment at 5.4%. Expectations were for 5.3%. X that, food and energy, those things that are volatile, only up 4%. However, that's still hot for what we've seen over the past 8 to 10 years. Just wanted you to guys take a look quick at the chart on the right here. This is the VIX, and that's kind of the measure of volatility within the markets. And you'll see we're at one of the lowest levels we've seen since, looks like back to September here. But, this is kind of like the heartbeat of the markets. You'll see these spikes when risk kind of turns off, and then when risk turns on, volatility kind of moves lower here. We're at 16.5, which is pretty minimal considering the environment that we're in right now and all the potential issues that there are abounding. PPI also came in hot, 8.6%. These are the producer price indexes, or the producer price index. It's what companies are paying for goods and services. And, the Fed seems to think that a lot of this has to do with some of these supply chain constraints. And, they're going to work themselves out, and they're transitory. And, we heard the FOMC minutes on Wednesday, and I think there was something like 79 mentions of inflation and over 50 mentions of transitory. So there's an ongoing discussion there amongst all the Fed members and whether or not this is going to be true. Some of the bullet points that we've seen come through, they believe as long as the economic recovery that we're currently in stays at a similar pace, they see that their gradual tapering that they're going to start sometime in November or December is going to end around the middle of next year, and that would be acceptable to them. Middle of next year, June, July, August, they're starting to move some money out of the purchases that they have. We'll take a look at some of those charts here in 1 second so you can kind of see how much stimulus that they've pushed into the markets. They did also establish more distinct and stringent guidelines for what they would cause, or for what would cause a rate hike. As of right now, market seems to be pricing in a November or December rate hike in 2022. We'll see if that actually comes to fruition because rates, for as long as I can remember, have been low. I would say, 2012, 13? I think they did try and hike them up a little bit pre-COVID, and then once COVID hit, they pulled it back out. As we discussed before, many participants expressed concern about this lasting inflation and the labor market constraint, getting people back to work. Let's take a quick look at some of these charts. I'm going to pull these up here. Some of these economic data charts. I put this together yesterday, so if the retail sales chart doesn't show it, retail sales came in at 13.95% on a year-over-year basis. So you'd see a slight little tick up here on the retail sales. Can everybody see these eco charts here? You should have inflation trends, retail sales, U.S. labor force participation. Just give me a quick yes, no, maybe so. All right, looking good. So let's just take a look at these inflation trends here. CPI, you have the in the dark blue here, seeing it move up from, back in May of 2020. We were almost negative on the PPI, so we were showing some deflationary pressures on producer price indexes. But as you can see, we are really ramping up here, and the Federal Reserve is going to have to try and get some control over this, especially if supply chain continues to be an issue. Labor force participation, as you'll see, once COVID hit, we really dropped down to an extremely low level. This goes back to 2007. You can go back even further, and you'll still see that this is one of the lowest levels in labor force participation that we've seen in a very, very long time. We're at 61.6% currently right now, after some people have gotten back to work, but still very low historically. Job openings, if you guys see this on the far right here, this is an incredible number. Even going back to 2014, this is the most job openings we've seen in a very, very long time. It's just the environment that we're in right now. Some people, disgruntled, not getting paid enough, wages aren't high enough, stimulus and government support has been, rather incredible. So, hopefully we'll see some people go back to work, as long as these companies can, kind of entice people back. But for some people it just doesn't matter. It's just not worth it. Moving on, let's take a look. This is one thing that we've been watching for a long time, is this Federal Reserve. If you look back here in 2017, the red line is the effective funds rate. You'll see we moved from this 1% level, and we were stair-stepping up as we got into just before COVID here in 2019. That's your interest rate. Almost made it to 2.5%. Now we're back down to the 0% level, which means that the Federal Reserve is easing and very accommodative and really pushing money into the markets. And on the right-hand side here, you'll see the assets in trillions of dollars that the Fed has been pumping into the markets. Previously, as you can see in 2017, they were slowly pulling money out of the market. We moved from this $4.5 trillion level, maybe down to slightly under $4 trillion. And now we've jumped up to this $8.5 trillion level. This is what they've been talking about as far as tapering goes. So we want to continue to watch this chart to see if this blue line starts to roll over a bit. That would mean that they're starting to pull money out of the markets, being less accommodative, less easing, tightening ever so slightly, because they don't want to screw up this economy despite the high inflation. For those of you who own homes, you've probably looked around the neighborhood and seen prices go up exponentially. You'll see on a year-over-year basis, Case-Shiller Home Price Index up 20%. That is an incredible number. You're talking about somebody who's bought a $400,000 home last year is now worth, $480,000 or more, depending on what particular city you're in. We've seen prices jump here in Miami, Fort Lauderdale by well more than 20%. I'm sure in some of the more higher demand areas as well, like Los Angeles, or even if people are getting back into New York City, we've seen some of these prices jump like crazy. S&P 500 CAPE ratio. I really wanted to look at these charts because sometimes we get too lost in some of the details in the day-to-day action. And as you can see in this CAPE ratio, this is the cyclically adjusted price to earnings ratio. And, price to earnings kind of takes into consideration this CAPE ratio kind of takes into consideration growth of a company's earnings compared to their valuation. And as you can see, back in 98 and 99, we saw valuations skyrocket there was this gigantic tech internet bubble. We're starting to creep up to those levels now, as far as in 2021 here. So, higher valuations can remain for a very, very long period of time, and they're very much supported by these low interest rates. If companies can really leverage up using loans or bank loans or government assistance, then these higher valuations can remain for some time. However, at some point in time, the valuations just can't be supported. So when that happens, I don't know. That could last another 3, 5, 10 years. I mean, as you see back here in 95, 96, 97, 98, I mean, that lasted a very, very long time of higher valuations. But when it cracked, I mean, it really, really took a dive here. Unemployment rate, you'll see the general unemployment rate here at 4.8%. U6, this is the underemployment rate. This is all the people that have given up looking for jobs, so they're not counted on the normal unemployment rate rolls at 8.1%. So making some moves on unemployment rate, but still plenty of jobs available. Last but not least, this is the Baltic Dry Index and shipping rates from Shanghai to Los Angeles. This is the cost of freight per 40-foot box, which is, what each container's cost. As you can see, back in 2020, a container was simply $2,000. Now we're looking at prices of $11,000. I mean, that's just out of control. So you can see why companies are really having difficulty both getting containers over to the U.S. and trying to keep costs low, because this whole supply chain is a big issue, and President Biden weighed in on that today, or not today, I'm sorry, I think it was on Wednesday. And basically he said every company that's out there needs to step up and participate in getting these supply chain issues resolved. He announced that the Port of Los Angeles is going to be open 24/7. This is on the heels of the Port of Long Beach being open 24/7 for almost a month now. These two ports on the west coast of the U.S., they account for approximately 40% of all the imports into the United States. But the problem is, as of Monday, there were 62 ships stuck at the ports right now. 81 were waiting still to be docked. So we still have a lot of containers stuck out there that can't be unloaded. Some of these changes that Biden was talking about will allow for 3,500 additional containers to be unloaded per week. But there still remains some concern around holiday gifts arriving on time. So I'm not sure if any of these changes are really going to matter, because I think, to me, maybe you guys have some better insight than I do, but manpower seems like the biggest issue to me. Truckers, longshoremen, moving these things, because if you don't have people, if you don't have that human capital, you're just not going to be able to move stuff. There's only so much that you can do by leaving a port open 24/7 if nobody's working there. And that's all to do with this 11 million jobs out there. So there's just plenty of openings. It's not moving. Other supply chain concerns: Vietnam has been on a strict lockdown for 2 months, which has kind of held up a lot of the clothing manufacturers like Nike, and some chip manufacturers are in Vietnam as well. So they've kind of shifted those manufacturers over to other places like the Philippines or Indonesia or even China. Trying to see if there's anything else that we didn't touch on as far as economic charts go. Next week is very, very light on economic data. We do have industrial production and capacity utilization on Monday, housing starts and building permits on Tuesday, and of course, always every Thursday we have the initial claims numbers. Moving on here, let's take a look at some of the indices here, because there's some really good levels on some of the domestic indices, especially the S&P. Let's see if we can move down here and check that out. All right, so we're on the S&P here. You'll see futures are trading up about 42 basis points, around 444 or so. So we're a little higher than yesterday here. We're around this 444 level. As you can see here on the altimeter, we have a lot of resistance to the upside here around this 444, 445 level. But it does look like to me, based on this chart here, that we have broken this short-term downtrend that the market's tried to establish. But again, if the Fed is starting to taper and pull money out of the markets, I guess we'll see how long this uptrend can last. But I think there's going to be a lot of resistance to the upside here on the S&P 500. Let's take a look at the Russell. This is a great chart here on the Russell as far as a textbook consolidation level. You'll see on the autopilot, we've been long on the Russell on a weekly basis for almost, I guess this was back in November of 2020. I had some whipsaw action here in the early parts of 21, but still stayed long until here about July. And now we're in a no-trade environment, as you can see the gray bars here on the weekly. But moving in between here, this consolidation period, this is a great kind of place to play. Right now, not so much. We're right dead in the middle. But if you can kind of play the outsides here between this 214 to 233 on a weekly basis, some really good levels to take a look at there. Somebody asked to look at the NASDAQ, the NQs. I'm going to look, or the NASDAQ futures. I'm going to take a look at the ETF first, and then we'll go take a look at the futures as well, which should look fairly similar. But you can see on the daily chart here, we have a bit of a breakout on the NASDAQ. It's got room to run from this breakout on this altimeter from 365, at least up to this 372 to 374 level. And then you're going to find some resistance there. I think if we turn on the radar, yeah, even in this level here, there's still not a lot of volume at price. So we may have room to run up to about this 379 level before we meet any kind of major pushback here in the market. So watch for the NASDAQ to run a little bit more freely. If we look left here, we do have a 1 point here around 367 of higher volume. But if we can make through that today, could have some room to run a little bit higher, at least in the next coming weeks. But watch for this high resistance here around this 379 level. Let's take a look at the futures contract as well. That's the AT NQ. We always use the AT symbol to take a look at generics. That way it brings in all the data rather than just the previous month's or just the current month's contract, or the front month, which I think is the Z contract right now. But as you'll see, very similar chart here. All right, let's move on. There's been a lot of pressure on the commodity complex, especially in oil. You'll see on a weekly basis, we've seen a very large move up here from the beginning of 21 at $40, $45 level oil per barrel. Now we're up to about $82 per barrel. And a lot of this has to do with increased demand, lack of supply. OPEC continues to keep supply at bay. They haven't really released a lot of oil. Have a feeling they're going to try and squeeze the market a little bit, try and get back some of the money that they've lost over the years when oil was way down here. I guess back in 2020, in this $30 to $40 range. But as we know, as oil continues to increase in price, it does help some of these U.S. producers potentially to get back online. I know back in 2016, 2017, we had a lot of the U.S. Drillers kind of go offline when oil dropped below that $60 level, which kind of didn't make sense for them to continue to push oil into the market. But for the foreseeable future, I think there's going to be some higher pressures on oil here, keeping it in this $70 to $90 range, unless OPEC decides to step in. Natural gas also, we can look at the futures and then we'll look at the ETF as well. Natural gas moving up exponentially over the last 6-7 months, showing a little bit of sign of resistance here, but a lot of support down low here on UNG and the natural gas. UNG looks very similar for those that trade the ETFs. Got a well-established high here on the altimeter around the 2070 level, down from the 18 level. Word of caution on UNG for those that do trade this. It does get into some weird backwardization and contango type deals with the roll. You'll see if we look way back here. I think it doesn't go back very far, but this thing goes up to about $2,000, and that's mostly because of this roll problem that natural gas has, and it gets a lot of contango and backwardation. So watch out for that as time continues. But on a weekly basis, not a lot of support or resistance. We do have one line on the altimeter that just started around 16.99 all the way up to 20.33. But again, very volatile here on the natural gas space, especially moving into the winter months here. Corn, just kind of looking at some of the ag products. You have this, let's take this off. This kind of continued slight downtrend on corn, consolidating. Wheat, similar, not as much pressure in the ag products. Copper, some of these industrial metals have been on fire over the last couple of days. We saw a massive breakout here on copper above this 440 level, moving up to 470. So some of these industrial metals, they've been tough to get, and demand has been extremely high considering home buyers, home builders and producing products. So one to watch out for. Gold has kind of been lazy. Gold and silver both have been extremely lazy considering the inflationary environment here. But we do have this long-term downtrend on silver here. Slight breakout, but as you can see, let's move in a little bit here on the daily chart. We had a little bit of a breakout here on silver in September, reversed right back down. So that downtrend is probably going to continue to play until we get, a much better move up higher. So I wouldn't be too concerned about these fake outs here on the upside. Just be careful playing the long end of silver considering the downtrend. But, with inflation, you would think gold and silver both would be the play, but I think a lot of people have moved over to Bitcoin. All the gold bugs have switched from gold and silver to Bitcoin. Bitcoin, we've seen a extremely large move up higher over the last several weeks. For those of you that do play the cryptos. Moving on, that kind of covers the commodity complex. Oh, we were still looking at some of the indices. I want to show you this chart on EFA, which is the developed international markets. Great little consolidation here. These tend to be some of my favorite plays because it may take a while. You got to be a little bit patient, but when they do play out, they do break out, and it's that rubber band. The longer the consolidation stretches, the faster it snaps. And in the meantime, you can kind of play these insides and outsides of the EFA here. But COVID seems to be still a major issue over there in the European markets and developed markets over there. So continue to watch this as we go on. EEM, the emerging markets, have been on a continued downtrend. Much of that, again, due to supply chain concerns and lockdowns in Vietnam and other various emerging market countries. Talked about the VIX, talked about treasury rates. We'll just take a quick look at the 10-year. Rates are moving a little bit higher. They eased off this week, but we did see it get up to about 1.6 on the 10-year. We've dropped back down to the 1.5 handle. But from a real rate perspective, real rates are down a lot considering inflation. So the fact that the 10-year moved up over the last couple of weeks is kind of a moot point because real rates have gone down quite a bit. Another thing worth mentioning as far as inflation goes, Social Security is going to be up 6%. I think starting next year. Correct me if I'm wrong on that, but that should put a little bit more money in the pockets of those people that are collecting Social Security. That'll give them a little bit more buying power. So you may see some inflation on that as well. I want to get to some of the stocks, but you know what? We'll look at that as well. We'll look at some of these stocks. Somebody asked about FedEx. FedEx is a good one from a shipping perspective, although we've seen a lot of pressure to the downside on FedEx, and that may be due to problems getting people working is my only guess. But if we look back on a weekly chart, I want to turn on the radar, see if there's any kind of support here, because this chart looks really ugly, at least from a short-term perspective. We may try and get into a consolidation point here since we do have some support in this 226 level. So it may be worth, trying to look to the long side here, just, on a little bit of a bounce on FedEx. You'd think with the upcoming holidays that, shipping would increase. I know they did increase their pricing, so all supportive of a higher stock price. But, ultimately, you got some really good downside support at 175 if we do get there in the near future. But something to watch there. I think UPS, let's see how they look. UPS has a similar issue. They have actually on the weekly chart some resistance to the upside here, so could be a nice little pair play on the FedEx UPS. A little bit on the short side on FedEx, potentially on a bias, and a little bit of long side for FedEx on the bias there on the long side. Any other stocks you guys want me to take a look at? I'd be happy to look at those. Otherwise, I want to look at some of the notable earnings that were this week. Delta Airlines came out. Earnings were 30 cents a share versus 17 cents on revenues of 9.15 billion versus 8.4 billion. One of the major things that they noted was increasing fuel prices. This could be put some pressure on them, as well as this is one of the first quarterly profits since COVID that they've had, not including government assistance taken into account. So Delta, nice little uptrend here since the beginning of 2020 on the weekly chart. Do have some really good support here on Delta on the downside. You can see these altimeters stepping up. That's a good sign of some good support down below and a good uptrend higher. So may want to play the long side here on Delta down to 40. Looking for some higher prices. JP Morgan and Bank of America also came out with earnings this week. They cited wealth management, fees increasing, investment banking increasing and trading being the major components to increased revenues on their side. JP Morgan came out beating earnings $3.74 versus $3 even, and revenues of $30.44 billion versus $29.8 billion. Again, they're seeing much higher fees from investment banking, wealth management, mergers, and IPOs, and a lot less loan write-downs, which has been good for them. Because I think they actually expected, considering COVID, a lot more loan write-downs or loan losses coming in through them. Bank of America, similar look here, breaking out to the upside on the charts. And that's the end of the market. One last one was Domino's Pizza. People may be getting sick. They did really, really good during the COVID times and quarantine. However, people may be getting sick of pizza, looks like, as I believe they missed on earnings. Let's see. What did they do here? On earnings, they were good on earnings, 324 versus 311, but they missed on revenues at $998 million versus $1.04 billion. So that's all I have for today. Good luck trading, everyone, and thanks for following along.